Today, we are looking at the buy prices of 6 more businesses out there. We're going to get right into it today. This is the second part of the to buy or not to buy post-earnings series, where we look at what the reasonable price is to buy a stock after the earnings season has come to a close. If you want to check out the methodology behind how I find these various prices, please check out part 1, which is linked in the description below. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. These are the 6 stocks we are looking at today: Nvidia, Apple, Amazon, Intuit, Applied Materials, and Fortinet. The 2 salmon color stocks I do not own, and the rest of the 4 I do own. First, we're looking at Nvidia. It has been a bit of a rough go for Nvidia since their earnings released last week. They are down over 6% in the last 5 days, and that comes off the back of a very, very solid earnings report, but the guidance left the market a little bit wanting. I did look at Nvidia's earnings in depth last week, so please check that out. But they closed the week at $167.02. And at that price, the market is pricing in free cash flow growth over the next 10 years based on a reverse DCF of 15.8%. So still very strong free cash flow growth projected by the market for Nvidia. I do have a buy price of $135, but that means they would have to come down nearly 20% to make Nvidia a reasonable buy in my view. Apple has been a long time position of mine that I just sold out of recently. I closed the position completely on August 12th, and the reason I sold out of Apple completely is that I don't see a great long-term growth catalyst like I do with, say, Amazon or Google or Microsoft. While I believe Apple will still perform very well over the next decade to 2 decades, I think there's just better opportunity out there now until Apple can show that they have some real growth catalyst driving this new phase into AI. Nonetheless, Apple still has a $3.5 billion market cap. They closed out on Friday at $239.69. The market is now implying free cash flow growth based on that price of 9.13%. Yet my buy price for Apple is at $180. So they would have to come down nearly 25% to be reasonable enough, in my view, to buy Apple. Apple was helped significantly by the Google decision earlier this week, where the judge ruled that Google did not have to divest Chrome and that Google was still able to make their payments to Apple to be the default search engine on iPhones. And that is why Apple has ticked up over the last week. But again, where's the organic growth? Theoretically, that Google payment should already be priced in. And I know that they're doing a massive share buyback program, but like I've discussed before on this channel, share buybacks aren't organic growth when it comes to earnings per share growth. Apple has a PE ratio of 36.4 and a forward PE of 31.5, both of which are higher than their 5 and 10-year averages. Again, I think these are very high multiples for a business that has not grown the way the other Mag 7 businesses have grown. Their 5-year total revenue growth, for example, is at 8.5%. And even on my 10-year projection for revenue growth is 4.6% on the bear case up to 7.4% on the bull case. So again, not a lot of growth to expect from Apple. It seems they have not innovated the way they used to, but we shall see what happens over the next couple of years. I mentioned their free cash flow growth based on a reverse DCF is at 9.13%. Mine is at 8.6%. And you can see the discounted cash flow price for Apple here at $182.25 for the bear case, up to $274.49 for the bull case. So if they do execute on the high end of things, and really that means margin expansion because of Apple services, and their revenue growth is above 7%, then there is some upside here. They do pay a dividend, however, it's minuscule, and really they buy back shares. That's how they reward their investors more than anything. And I know a lot of people compare Apple to Google and Microsoft, but remember, at the end of the day, Apple's a hardware company. They make a product. That product is the iPhone more than anything else. And that is the core of Apple's business. It is the entry point into the entire Apple ecosystem. So there's no real good comparable for Apple in my opinion anyway. So that gives us a buy price of $225 without any margin of safety, but where I get my buy price from is because we do have a margin of safety. For Apple, it's at 20%, and we can see it's at $180.70 and a forward PE of 23.8. So like I said, Apple will have to come down quite a bit to even come under consideration for adding back into the portfolio, but I'll be honest, this is a stock that I no longer want to have in my portfolio until they can prove that they are growing again. Amazon is a business I am quite bullish on. I believe they have a really bright future ahead, especially with AWS leading the way. The very profitable segment in cloud computing. Amazon has a market cap of $2.48 billion. Going into the weekend, they have a share price here of $232.33. They fell a bit post earnings. Again, the market was a little bit worried about the CapEx spend that Amazon is engaging in. And if we're being honest, AWS growth was significantly less than what we saw out of both Microsoft and Google. Nonetheless, since that post earnings drop, Amazon's share price has nearly clawed back to their pre-earnings price of $234, is implying very strong free cash flow growth going forward for Amazon, as am I, 19.5% on a reverse DCF basis. I have a buy price of $215, so in my view, there was some opportunity there post earnings. I did scoop up a couple shares myself. We want to see them come back down a little bit before we would want to buy more, at least 7.5%. Intuit has an incredibly strong future ahead of them. I did a deep dive into Intuit a few months ago. I encourage you to check that out, where I explained in depth what their future growth opportunities are. A big part of it is international expansion. Up until their latest earnings, Intuit was ripping in 2025. However, in the last month, they have fallen 14.3% in the market, and their year-to-date return now stands at just over 7%. Their price is at $672.82, and that's an implied free cash flow growth of 8.5%, which in my view is very conservative, which is why their current price is under my buy price of $700 by about 4%. They had a very strong earnings despite their fall in the market, and like I said, this is a business that has a very strong future ahead of it. Intuit has a PE ratio of 49 and a forward PE of 43.4. Their PE ratio is below their 5 and 10-year average, while their forward PE is below their 5-year average and slightly below their 10-year average. Like I said, the market is pricing in a reverse DCF of 8.5% for Intuit. My base case has them at 12.2% free cash flow growth over the next 10 years. And that results in a DCF bear price of $686.78 up to a bull price of $1,317.15. If they execute and hit that bull case, that means they have revenue growth of 13%, an operating margin of 33%, and a free cash flow margin of 44.7%, all by year 10. Intuit pays an incredibly good dividend, and it's a growing dividend as well. My bear price on the dividend discount model is at $742.43 up to $1,182.88 on the bull case. And that is projecting dividend growth from 13.5% to 15.5%. The exit multiple is actually dragging this valuation down slightly. It's at $605.93. And that is with comps of SAP, Salesforce, Uber, Cadence Designs, and Autodesk. That gives us a buy price for Intuit without any margin of safety of $862.15. We apply a 20% margin of safety, and that's $690.52. Now, I did say a $700 buy price, and the reason is because I believe this is a safer business than what a 20% margin of safety gives us. So a $700 buy price seemed reasonable to me. Applied Materials is next on this list, and this has been a very stagnant year for Applied Materials. Going into 2025, the market and myself was expecting stronger growth on the top line for Applied Materials. We haven't really seen that bear out yet. There are issues, of course, geopolitically with a lot of the trade tensions going on with China and Asia in general. And of course, Applied Materials has a very large segment of their revenue comes from the Asia Pacific region. And it seems like the semiconductor cycle recovery has been a little bit slower than what the market has been expecting as well. So Applied Materials went into the weekend at $162.75, and that is only 4% free cash flow growth implied by the market over the next 10 years. I have a buy price of Applied Materials of $190, which right now, in my view, they're undervalued by about 16.7%. So I still think this is a very good buy. The growth story for Applied Materials centers around their position and providing the equipment necessary to build out the infrastructure for the AI future. They're a semiconductor equipment firm, so they build much of the leading edge technology that actually manufactures these high-end AI chips. So they're a very important part of the overall semiconductor supply chain, but they are underperforming just a little bit at the moment. Applied Materials has a PE ratio of 19.4 and a forward PE of 20.4. That PE ratio and forward PE are both above their 5 and 10-year average. So theoretically, the market's actually a little bit more optimistic about Applied Materials than they have been in the past. Again, the reverse DCF is implying a 4.1% free cash flow growth over the next 10 years. My model for the base case has it at 5.7%, so I'm slightly more bullish than the market. But as you can see here, there's a lot of upside for Applied Materials based on these very conservative numbers alone. The DCF on a bear case is at $184.85 up to $278.13 on the bull case. The bull case is implying 8.3% revenue growth per year over the next 10 years and free cash flow growth of 8.3%. Again, very conservative numbers in my view. They also pay a very nice dividend. Bear case dividend here of $202.43 up to $296.62 for the bull case. That assumes dividend growth of 13 to 16%. And we have an exit multiple of $241.21. And that is based on comps of ASML, Lam Research, and KLAC. So without any margin of safety, that's a buy price of $235.98. A little over a year ago, they were trading in the 250s when the market was expecting a strong recovery out of the semiconductor industry. But since that hasn't come to fruition the way the market has expected, their share price has definitely taken a bit of a beating. So with a 20% margin of safety, that is where I get my $190 buy price. And you can see even at today's price, in my view, Applied Materials is trading in a 30% margin of safety realm. I do think there's a lot of upside here for Applied Materials, especially as the AI thesis plays out over the next 5 to 10 years. But we do need to exercise patience with this business because it is a very cyclical industry and the market does not like slow growth. Fortinet is a business that keeps posting strong numbers quarter after quarter. However, this past quarter, they took a huge hit post-earnings, dropping over 25%. And the reason there is twofold. Their guidance was weaker than what the market was expecting, and their anticipated hardware upgrade cycle has been underwhelming. On the guidance, they took a very conservative approach and cautioned the market that they're not seeing the type of investment from businesses due to the uncertainty around the tariffs. And when it comes to the hardware upgrade cycle, they said it was nearly complete. I believe about 70% complete. Correct me if I'm wrong there. But it didn't provide as much top line growth as the market was expecting. So Fortinet was punished hard for that. They hit their 52-week low at that point, $70.12. So they have recovered a little bit from that low. However, it has been fits and starts for their stock price. I do have a buy price of $85, so I do think right now they are a good value here. They are undervalued by about 7.8%, and the market is now only projecting implied free cash flow growth for Fortinet at 6.9%. Fortinet is one of those businesses that continues to pump out strong earnings quarter after quarter, and I have no doubt that they will continue to do so. And right now, there's some good value for investors. Fortinet has a PE ratio of 31.4 and a forward PE of 31, both of which are well below their 5 and 10-year averages. And like I said, the market is implying free cash flow growth on a reverse DCF basis of 6.9%. My own base case has them at 12.6%. That means a DCF bear price of $84.46 up to a bull price of $152.50. The exit multiple sits at $95, and that is based on comps of Palo Alto Networks, Synopsys, Cloudflare, VMware, Qualys, Juniper Networks, and F5. So you can see each of these cases has some upside here, and without any margin of safety, that is a buy price of $108.63. Of course, we're applying a 20% margin of safety with Fortinet, and that gives us an $86.90 buy price, and that's where I'm getting my $85 target from. So the theme of this earnings season has been one of punishment. If your guidance is less than what the market was expecting, or your growth slowed just a little bit. And we've seen that with many businesses so far, Fortinet being one of the latest victims, but also seeing drawdowns in Applied Materials, Intuit, FICO, and many, many more. So those are the 6 businesses we're going to cover today. Next week, we have another big earnings coming out. That is Adobe. And I also want to cover a few more buy prices to close out yet another earnings season. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.